Good morning, good afternoon and good evening everyone. Welcome to the Mayar Capital Q&A for the second quarter of 2023. I'm joined as always by Aziz Alnaim, Portfolio Manager, and Aubrey Brocklebank, Head of Research. The contents of this session, as always, is driven by you, the audience. So if you do want to ask a question, please use the chat function in Teams and we will get to it time allowing. We do have a number of pre-submitted questions. Thank you to everyone who has sent those questions in. And we have quite a few to get through. So without further ado, let's get into them. And we're first of all going to start talking about performance and some historic performance as well. Please explain why Mayar missed on the market performance of 2021. For those of you not familiar, the market was up around 20% in 2021. The Mayar Fund also up, but not quite as much, just shy of 8%. So Aziz, a few comments. I think mainly about the second half of 2021 is the real salient part there. And I can tell by the look on your face, this is a particularly painful period of performance to recount and revisit. But, you know, client's always right, so.
It is. And to quote Charlie Munger, we like to rub our faces in our mistakes. So there's no doubt that it was extremely disappointing. And I think at the year-end letter.
Right. I think we're back. Sorry about that, everyone. We had some issue here. May or may not have been prompted by the question about underperformance. But I can assure you that I didn't pull the plug out. Aziz, do you want to start that question again?
Sure. There's something weird happening, I think, with the camera as well.
Yeah, I think we're
just zoomed out. Is that what it is?
Yeah.
Right. This is what you get for asking a difficult question that we don't want to answer. So the question was basically, to recap, why was the 2021 performance disappointing? And Marc was mentioning that the market was up about 20%, we were up 8%. And the first thing I said is that most of the performance of 2021, or the underperformance, was essentially the second half of the year, where all of this differential performance unfortunately happened. It was essentially, we can get into a lot of details, but essentially what happened comes to the very fundamental level is the market went up a lot. And we went nowhere, and that happened for two reasons. I think one is that the two reasons, and both of them are driven by the same input. The first one is that we had started selling a lot of our holdings, and none of the things in our wish list were kind of flagging by as a buy using our valuation metrics. So essentially, it was a product of our valuation discipline. We sold the things that we thought had gotten a bit ahead of themselves in terms of valuation, and we couldn't find anything else to buy. And so cash drifted to record high levels, actually. I think in the latter part of that period, we were running at about 25% cash, which I can't remember the last time that had happened. And I think both things were driven essentially by us being too conservative or too pessimistic, depending on how you want to. Obviously, with the benefit of hindsight, it turns out we were too pessimistic as opposed to too conservative. But essentially, we were very negative about what we thought businesses are going to do in terms of volumes, pricing, etc., coming out of the pandemic. And the reality is the economy turned out to be a lot hotter than we had anticipated. And so the companies did exceptionally well beyond companies across the economy did much better than we had anticipated. So what we thought was excessive valuation, with the benefit of hindsight, may turn out to be well-founded. Now, you can come back and say that we were right and being pessimistic, given what happened in 2022, where the market came down a lot. And I, in all honesty, cannot take credit for that for a very simple reason. Even though, yes, the market did come down in 2022, But I don't think that the factors that drove the market to go down in 22, basically high levels of inflation, fastest pace of rate increases, the war in Ukraine, etc. None of these were in our models in kind of mid 2021 when we were selling the things that we owned and not buying other things. So I cannot take credit for that, even though with the benefit of hindsight, it looks like we were right. I don't think we were. I think we'll make mistakes from time to time. This one was exceptionally painful. It's a mistake that is essentially an extreme outcome of our process. So it's not out of character for us to be conservative. It's not out of character to be conservative at that point in time in the cycle. But the output of that was exceptionally painful, both because we were unnecessarily pessimistic with the benefit of hindsight, and the market overall did exceptionally well in those 6 months when we underperformed. So I think the combination of both was obviously very painful. And that 1 6-month period is what's been driving our underperformance the past 3 and even 5-year track record. It's just what happened during the 6 months, which makes it even more painful. Aubrey, do you have anything to add there?
No, really just that, we are conservative. We put risk before reward. And that does mean that sometimes, especially at the top of the market, we can go through periods of underperformance. And, the question is, going back, if we had a similar situation, would we make the same mistake again? Hopefully not in the same way, but we'd probably be conservative. And
well, yeah, I mean, I agree that this is why I said it's not out of character for this to happen.
Exactly.
The degree of it was a bit extreme.
Yeah, but
and I wonder how much of the degree part has to do with just how foggy things were coming out of COVID. It's very, very easy to have some revisionist history now.
yeah,
I'd like to ask a question about the importance of process in periods like this, because obviously you can look at the process and say that it didn't work over this short period of time. But of course, the long term is made up of lots of individual 6-month periods where you did stick to that, where you were contrarian, and it ultimately drove long-term outperformance. And do you think that's worth highlighting at this point?
I think it's definitely worth mentioning. I think the other thing that's worth mentioning is whenever you have a process or any decision, and this is why I kept saying the benefit of hindsight, but it's easy after the fact to say this is what happened and you're wrong. But if you looked at a situation where there is even if we take an extreme situation, let's say there's an 80% chance that things were not going to do well and a 20% chance that they were going to do well coming out of 2021. And not by any stretch of the imagination saying that that's actually the probability at the time. But even in that case, and you made the decision based on the 80% of probability, the 20% outcome can still happen. And in retrospect, it looks like you were too pessimistic. So there's always that chance that it happened. And I don't think it's out of character for it to happen. And like you said, a track record is made out of many 6-month period, and sticking to our process is important for the long-term performance. I do think that the degree of outperformance in a short period of time has been something that we hadn't experienced ever, essentially, and it was painful. I'm not denying that it was painful.
Okay, so let's looking backwards, maybe a slightly shorter answer for our next question about performance, which is about future performance. What is your forecast for performance over the second half of 2023?
Well, I think if I were to wish upon a star, there's a dark joke about that, but I'm not going to go there. But I'd say the next 6 months would be the reverse of the 6 months that we talked about in 2021, and completely reverse that period's impact. But the truth is, I have no idea what's going to happen over the next 6 months, or to be completely honest, over the 12 months. I mean, we do not make decisions based on 6 or 12 month periods. And The reason we don't is that we don't think we have the ability to forecast, etc. If we could, then we'd use them for our decision making, but we really have no idea. We think in the short term, the proportion of inputs that are basically complete noise so high that it's just too difficult to try to kind of find the signal in that fog of noise. I know I'm mixing my metaphors here, but Aubrey?
The market's going to go up, down, sideways, and but yeah, in the long run it will go up.
Okay, well, moving from one of your least favourite topics, i.e. short-term future performance, we'll go to another least favourite, which I guess is macro outlook on earnings, disinflation. We've got some questions about regarding interest rates and whether any of these macro forces are prompting us to change the portfolio in any way.
I'm going to let Aubrey answer that question.
So, I mean, actually, one of the things that we've been talking about for a while is that, as inflation subsides, we're going to see the improvement in margins in the businesses that we own, and that, what happened originally when inflation came on, it came very quickly. So a lot of our businesses, they weren't able to pass the cost through immediately because it's not this immediate thing. If you're Unilever or if you're Bright Horizons, you can't just all of a sudden push the whole lot through, straight away. So it takes time, and they've staggered it. Now, as they've come down, as inflation comes down, this is going to prove, this could prove really beneficial to a lot of margins, and we're starting to see that in earnings. So, what we're seeing is, we think really positive and really exciting for our portfolio. Am I going to forecast how far deflation goes from here, or disinflation? No, again, for the reasons we've already said about forecasting, but from what we're seeing now, it's looking positive, and I see very little reason for that to change all of a sudden. I mean, of course, sort of heat waves in the world, and that could impact harvests, and that would be fairly painful. But that aside, the trajectory seems to be positive.
I guess one of the things that we've talked about in the past is the reason we like buying quality businesses is you don't actually have to be bothered by these questions if you look over a long period of time of multi-years, because companies are adaptive and they can eventually pass on increases. In the short term, anything can happen, and companies do face challenges from time to time, but the benefit of owning companies with a competitive advantage is that over time, this isn't actually a risk for that type of business.
Okay, and I guess we take a step closer to the portfolio, moving away from global macro and maybe some top-down country views, particularly in emerging markets. We've been asked specifically about China, about India, about GCC, which of course includes Saudi as well. And so do you view these markets with regards to their medium-term growth story? Is the political risk and everything else that comes with emerging market investing, does that just outweigh the investment opportunity that you see in those particular markets?
Well, my view for a very long time is twofold. One is, with the current fund, we have for many years targeted a certain kind of risk-reward profile, which fits within a developed market kind of universe. And so that's why for the past 20 years or so, that's essentially where we've done our investing, essentially North America, US, Canada, Western Europe, and developed Asia. And that will remain our focus for the global fund. That's the mandate that we've agreed with our partners on, and that's the mandate we'll stick to. In a more philosophical kind of, way of thinking about things, I do not necessarily think that emerging markets in general should be ignored. I think there have been and there will continue to be opportunities in emerging markets, whether it's individual emerging markets or emerging markets as a universe overall. The way to capture them is, in my opinion, to have a more specialized knowledge of individual emerging markets, where you can become a specialist in one, two, or a handful of markets, as opposed to just a broad stroke approach to all EMs. So we're not philosophically opposed to it, but as things stand, I don't think we are in a position to invest in emerging markets or China, for example, with the team that we have now. As some people know, because this is now, they've seen probably public postings about job openings, we are in the late stages of exploring launching a Saudi strategy with some investment in the GCC. Now, everything that I've said applies to Saudi and GCC. The big difference is that Saudi and GCC is a market that I've known for a very long time. And we're going to build a team that's become a specialist in those geographies. And so if and when we do launch that strategy, we haven't kind of hit the go button yet, but if and when we do, it will be focused on that geography within a specific fund or SMA structure. It will still not be within the global fund. I think they're fundamentally very different areas. So we're not opposed to anything. It's just we have certain skill sets and we need to make sure they match whatever strategy we run.
I think it's worth highlighting as well that those emerging market themes are actually present in the portfolio more or less. If you look at something like Richemont or Unilever in the consumer space, a lot of Asian consumer emerging market stories centered around consumption of new markets. That's an exposure that we can gain through developed markets.
No doubt. If you look at in our recorded letter, we always report geographic exposure by geography based on revenue. And so a significant percentage of our portfolio revenues do come from emerging markets, all of the above. I think the question is specifically if you want to own companies in China or own companies in India or other emerging markets. And I do think you need to become a specialist. I do think that for us, that's a requirement to overcome some of the risks and around governance in some of these other areas.
Okay, now moving on to more stock-specific questions. I'm delighted that one of the topics that we covered in the annual meeting, namely Vistry, has been raised as a question. We enjoyed learning about Vistry Group at the annual meeting, which covers movement in the new home sales market. Adding the existing home sales market to your views, would you consider the home furnishings market an interesting place to be as well? I guess this is more of a complementary exposure to Vistry rather than a direct exposure.
Well, I mean, I think I want to hand it over to Aubrey in a minute to get a bit deeper into this answer. It's certainly closer, and he's the expert here on this topic. But historically, home furnishings, with very few exceptions, and if some of you remember, we used to own Alnaim, which is technically within kind of that submarket. But generally speaking, it has not had the attributes that we like in a business in terms of competitive advantage and so forth. There have been a few exceptions here and there. Famously, Berkshire owns Nebraska Furniture Mart, though I think the advantage there is probably unique to that business and not to the category. I think there are a lot of adjacent things. We own houses, for example, so there are adjacent businesses to housing where we have found businesses with competitive advantage, but not necessarily in furnishings per se. Aubrey?
Yeah, I mean, obviously, as you mentioned, we haven't done Elm, but that's a slightly separate separate case because that's an exceptionally well-run business. But I mean, the first thing is, the question asks about new sales versus existing sales. And, because of interest rates, especially in this country at the moment, existing sales are, have really dried up. The sort of liquidity in the property market has dried up, hugely. And that's because, if you have a 2% mortgage rate fixed for 5 years, you're not going to want to go and move house and buy somewhere at 5%. Or actually, no, I think mortgage rates are now, 6.5.
699 is what I was offered last week.
Yeah, you're not going to trade in a 2% mortgage for 7% mortgage. So you're not getting those sales, and those sales, it's the volume of turnover that's really going to drive, home furnishings. You buy a new house, you want new curtains, you want new, cushions, rugs, everything else. And the new home sales are just sort of a part of the turnover. So without existing sales, it's probably not a great time at the moment. It's easy talking about short-term things when we're not investing in it.
I also think that the home industry have done a tremendous job rebranding things as existing home sales as opposed to used housing.
That's true.
I was hearing about existing car sales.
I mean, existing car sales, but not a yes, that might help with their image. But no, so as I say, until interest rates come down, home furnishings, I think will struggle from the sales perspective. Now, obviously, that's in this country, whereas in America, we are actually seeing interest rates come down. And, my little brother was saying that he might buy a new house if interest rates come down a little bit further. Actually interesting, I think the chart that, we saw the other day about how, in America, and this is perhaps unique to them because of the length of mortgage term, as the sort of secondary, the existing home sales dried up, because of that, new sales, absolutely boomed because they're the only things that were actually on the market.
Well, in the US, I mean, take my example, I've got mortgage reset, so that's why I'm immediately now exposed to real-time rates. Whereas in the US, if you had a 30-year mortgage that you got at 2.5%, you're going to probably pay it off at rates that you'll never see in your lifetime. So the dynamics, I think, are very different.
Yes. But, at the same time, Vistry sales have actually still remained strong, despite saying, oh, it's difficult and things. They keep selling houses because, this is one of the things we like about, Vistry. They sell affordable housing, which the demand is just always going to be there. We have such a shortage of supply in this country that it has to happen. And especially then with the partnerships where you have the local councils who are funding that. But why do we really like Vistry compared to, let's say, a home furnishing business like Alnaim? Well, because we can look at it and say, okay, this is the value of the land they own that they're going to sell. Even if property prices fall by this much, we still will make money on this. So it really protects our downside on that. Sadly not on a mark-to-market basis on a 6-year view, but over a 5-year view, we are very confident that the downside to this stock is very limited, whereas the upside is very, very high. With the home furnishings business, you just don't have that downside protection. Things go badly. If for any retailer, if things go badly, it can just become, very, very painful, very, very quickly.
Okay. We've just got a couple of questions that were submitted during the call and beforehand as well, but just a reminder.
I think given that we went offline for a bit towards the beginning, we should give people a little bit more time.
Yeah, we'll do that. We'll give you a little bit more time. If you did submit a question, it may have been in the technological black hole where it currently remains.
And we answered it brilliantly, by the way.
So don't feel shy about asking additional questions. But for now, we've just got a couple left. The first is about Google and PayPal. Just interested about your evaluation of those two names. Does the thesis still hold, and what's your outlook for both of those?
Well, maybe I'll take Alphabet and and Aubrey can take PayPal. I think the view on Alphabet towards the end of last year was very negative. When ChatGPT came out, people got extremely pessimistic about Alphabet, Google specifically is the business. And our view is that while there is potential downside to cost margins, there was also potential upside in the long term, and that the stock had overreacted to the downside relative to the risks that we were seeing, and that it more than baked in the negative downside, which is why I think we started selling Alphabet down to a very small position late 2021 into 2022. We rebuilt back the position earlier this year, and it now became on any given dates the largest or second largest position in our portfolio. We think the business remains an exceptionally good one. We think the competitive advantage is still there. We do acknowledge the risks that AI could create for the business, but we also think there are upside opportunities that come from it. So on the balance of risk basis and with valuation in mind, we still like our investment in Alphabet. But it is something that we're watching very closely and very mindful of the downside risk that could come from what AI could do, specifically, not just from a top line basis, but also the bottom line when it comes to higher cost to deliver the service.
And then PayPal. So look, this is a business that processes something like $1.4 trillion a year. They have 35 million merchant users, 435 million actual users. And then of the 475, the largest digital merchants, 83% of them accept PayPal. And the second place would be Apple Pay with 48%. So you look at this, they're ubiquitous, they are absolutely massive, they have scale, and they have a defensible moat here, and they are still growing. They're growing in line with e-commerce, but not just that, they're still able to take share from the incumbents. So yes, the new guys are taking a lot of share, and yes, there are competitive threats, but it's the incumbents that are really suffering here, not really PayPal. And the market has just become very aware of this, acutely afraid of this risk, which is one of the reasons it sold off, plus as well the termination with eBay and all those sort of things that quite a while ago. But it's now at a price that's attractive for a stock that we believe is still going to keep growing. Now, it's not going to keep growing at the sort of rates that a lot of American investors tend to like. American growth investors love these sort of 20% growth stocks. But actually, when you've got a business that can grow, sort of high single digits, low teens, actually that's actually wonderful. And I think we could see that sort of growth for quite a long time to come. And when you're paying sort of very reasonable multiples for a business with that sort of scale, I'm very happy.
Yeah, I think the other thing that I'd like to point out is people don't necessarily know when they're using PayPal. Because a huge part of the business is in the background.
Yes, it's 2/3.
Yeah, where it's not the PayPal button that you see when you check out. They're still there processing things in the background. And then, as you mentioned, there's just so much market share that is being lost by the incumbents. Yes, even the faster growing competitors today, have started from a smaller base, but also they're all coming after the legacy. So there's a lot of room for growth. PayPal may not be growing at 20-something%, but then again, you're not paying for that growth either. And I think it's got a value investment mindset there, I think.
Yes.
Okay, well, I think it's time for one final question. It's more of a portfolio construction philosophical question and regarding diversification, how you think about that and how it affects the investments that you make.
Well, I think diversification is a delicate balance between being so diversified that not only nothing bad can hurt you, but nothing good can help you as well. And the other extreme where you put all your bets in 1, 2, or 3 ideas. And if you're absolutely right, you can make an absolute killing, but one of them can then kill you. And it's a delicate balance, I think, between both. And I know people like Munger, Charlie Munger in the past kind of advocated an extreme version of the latter, where you own 3 to 5 holdings. In all honesty, I don't think I'm as smart as Charlie Munger, so I wouldn't have the confidence to do that, and I wouldn't forgive myself if I'd gone into that kind of concentration and one of them blew up in my face. I take my job just too seriously from an emotional point of view. But I think the other extreme, which you see in the industry where people own 200, 300, 400 names, is just absolutely silly. Because at some point, nothing you do will move the needle, and you might as well just give up and buy an index fund. So I think it's that delicate balance. And for the past, 12 years or so since we made that formal, we've said that we're targeting 20 to 30 names, with the top 10 being at least half of the portfolio, and we've kind of stuck to that. I think that's a reasonable compromise between the 2 extremes. But it is more concentrated than average people in industry, and the byproduct of that is you will have lumpier alpha from time to time, and that's just the nature of things.
But let's not confuse diversification with concentration, because so much when people ask us about being diversified, they're thinking about the number of stocks. Well, is that 25 or 60? Are you diversified at 60 or 25? Well, hang on. If I own 60 tech stocks, I have far less diversification than owning 20 stocks, which are well thought out and well picked across a broad sector of geographies and sectors. So you look at our portfolio, and we have lots of different sectors, and where we do on the odd occasion have 2 stocks which are very similar, you then reduce the position size so that you're not overexposed to that exact sector. So I would say that we're probably more diversified than many portfolios out there that have a lot more names in them. Just because actually we take care not to go and just stuff it with tech stocks or popular stocks or oil stocks or whatever, just because that's what's the flavour of the month.
Understood. Point.
Understood. Well, thank you very much. That brings us to the end of the questions that we have. If you feel like we haven't answered some of those, please feel free to reach out to me or the rest of the investor relations team, and we can answer those questions. If you are in London over the coming weeks, please let us know. You may see that we're in a new office here. We'd love to show it to you and hear about what you're thinking as well. But for now, we'll leave it there and say thank you very much for everyone for joining, and see you at the next Q&A. Goodbye.
Bye.